Welcome back to Palisade Radio. I'm your host, Tom Bodrovics. This is just a short intro for today's podcast with David Hunter. It's a bit on the long side, but he paints a very concise picture of how everything fits together, from the bond markets to interest rates, money printing, and gold and silver. You can reach him at Dave H. Contrarian on Twitter. He runs an investment letter by subscription only, and you can also reach him at dhunter31@gmail.com. I hope you enjoy it. Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is an absolute legend, David Hunter. David, how are you today?
I'm great. Thanks, Tom, for having me.
Absolutely. As I say, we're just delighted to have you here. Somebody with the experience that you have, over 47 years in the markets. I was just thinking we could start, if you could give us an overview of where we are in the markets today. From your experience, give us a sense of the timing of this particular crash and what we can see coming into the summer here.
Well, we've had, obviously, as everybody knows, we had a rough March and got down on the S&P down below 2,200. I was taken by surprise, as were most people, I think, by the virus and, how far it went down. I had been coming into this year, I had been talking about a melt up and talking about market moving up and up near 3,400, actually started about 3,200 on the S&P. I started talking about the need for a correction. There were just so many people that had kind of gotten on the momentum bandwagon. People who had been bearish all the way up had turned, more positive, and were starting to sound like me, which was I had been bullish. So I said, I think, the market needs a rest, and for a couple hundred points up, I didn't say it was going to start at 3,200, but I said we got to start thinking about a correction coming at some point. So for a couple hundred points there, I had a lot of people kind of beating up on me saying, this thing's just going straight up. You're wrong. They're not going to correct. And I said, no, I'm still comfortable saying at some point here, we'll have a correction before we have the melt up. And my idea of a correction was probably a 10% correction. So, down, I was looking at 2,900, 3,000 as kind of the level where it had broken out from, and that it would go back there. So I saw that coming. What I didn't see coming was the next 700 points from 2,900 down. So I missed it. I mean, I certainly didn't see the crash, but for good reason, we shut down the economy. The virus obviously was a black swan event that we just didn't anticipate. So, but down, I stayed pretty consistently saying this is not the end. We'll come back from this. And at 2,200 or thereabouts, I said, this looks like capitulation to me. I know a lot of people weren't saying it didn't feel like we had seen capitulation. We were talking about a lot lower. But I said, this feels like capitulation, and I think we will, this is a very important bottom. Sentiment numbers at that point were, by many measures, equal to what we saw in 2008-9. So, it just felt like people were really getting way too bearish. And in spite of the fact that the economy was really in trouble there because of the virus, I felt there was going to be a reversal, and a fairly sharp reversal. As you know, all the way back up, we've had now over a 700-point rally in the S&P, and all the way back up, people were saying, we're going to retest, we'll probably fail the retest and go lower. So, people said, okay, you get 200-300-point bounce, but it's going back down. And I kept saying, no, that was a capitulation low, and that this thing was heading a lot higher and ultimately would head into a melt-up. So,
just before we move on, David, would you mind just defining melt-up for us?
Sure. Melt-up, in my phraseology, is basically a parabolic move where the markets just basically feed on the fear of missing out. So as the tape gets steeper, more and more people jump on. And I've been, for all my career, I've been a contrarian, and I've been a very big believer in the psychology of markets and learning how to use that psychology and work against it. And for sure, what I call the momentum of the tape, either up or down, has big influence on investor thinking and behavior. So as we gain momentum in the market, in the tape, we will see more and more people get bullish. What you will find if you look at history and at sentiment, at tops, you have the maximum number of bulls typically, and at bottoms you have the maximum number of bears. So people are getting most bullish when they should be bearish and most bearish when they should be bullish. And that's what a contrarian does, reverse that. So try to buy low and sell high. So I believe we're late in a secular bull market. I think we'll see the secular bull market top this summer. And that secular bull started, in my opinion, in 1982. That's rather controversial. Lots of people think we started a new secular bull market in 2008-9. Some think we started one, other times. But I view 1982 as the beginning of this bull market because that's when disinflation really began. We had the inflation peak in the early 80s, and then the bear market bottom in August of 1982. And it's been basically a long run since. We've had cyclical bear markets throughout this, but within the context of a secular bull, meaning higher highs, higher lows. And so I think we're still in that. Secular bull market started in 1982, ends this summer. I have been saying for quite some time, I think the top is going to be somewhere above 4,000 on the S&P, so could be, 4,050, could be 4,500, but somewhere in there is my target for a top. And obviously getting from here to there in the next few months would be parabolic, and that's what I expect. So there'll be pullbacks along the way. We're seeing one right now, or at least looks like we're seeing one right now. And we just had the market move in basically a 61% retracement of the 3,400 to 2,200 drop. We've retraced 61% of that. I don't really use Fibonacci, but lots of people do, and it was basically a Fibonacci retracement. Like clockwork, everybody's, with the market rolling over here, saying, okay, that was it. Now we're going to go back and retest. So you're going to quickly see sentiment move negative again because people haven't believed this rally all the way up, and they now think it's over. I don't. I think this pullback probably lasts a day or two or three, and we already, we're having a pretty good sell-off this morning. And I still think my short-term stuff, I don't put a lot of conviction behind, but I think we could see the S&P rally to something just over 3,100 and then see a little bigger pullback, maybe a 250 point pullback from there. So, that would be, say a 10% pullback from there. So I'm not sure this is the start of it. It could be, but I think more likely this is short-lived and we run up higher before we have a more, a little sharper pullback. I think pullbacks are going to be sharp and short no matter what because we're in this steeper slope. But anyway, so that's kind of my short-term outlook. But, beyond that pullback, whenever it is, either now or at 3,100, beyond that, I think then we really get into the melt-up phase and the market starts rallying even more steeply than it has, in April. And I think we can see 4,000. I say by Labor Day, but I wouldn't be surprised if it is, we see the top sometime in July, August. It's hard to tell. It depends on how many pullbacks you get along the way, but I think this thing could really get going. And what drives it? I think it's driven first and foremost by the massive money pump that we're seeing, both from the Fed and from the federal government. We are putting unprecedented amounts of liquidity back into the system. So yes, we've been hit by a very big shock, an unprecedented shock to the economy, but we're also seeing an unprecedented response. And that, as I call it, money in banking 101. You get in every recession you've seen, the Fed prints money. That money at first doesn't have There's no economic demand for that. The economy's during recession is depressed and doesn't. There's not people out there looking for loans and looking to start businesses, et cetera. So that money goes into the residual, which is the capital markets, the bond market, and then the stock market. And that's what fuels rallies at times when the economy looks awful, but the stock market is anticipating what that money will ultimately translate into in terms of economic recovery. So we're seeing in lots of ways pretty much the typical response to money going into a vacuum and then ending up in the markets. You hear a lot of talk about how the market's not being rational, the economy is weak, and yet the market's strong. It's because there's a long lag time before that money translates into the economy, and with the shock we've had, the lag time may be even longer for many businesses. But I think because the Treasury is putting so much money in as well as the Fed, and it's going into people's pockets directly, this time it's quite unprecedented. We're not normally the Fed is responsible for this, but this time because of the shutdown of the sheltering in and shutdown of the economy, we're providing people with checks from the Treasury or from the IRS. So you've got $1,200 per person plus $500 per child, and also the $600 the federal government's supplementing in terms of unemployment per week for people. Those are just huge numbers. And yes, people are sheltering in place and don't have access to malls or restaurants to go out and spend their money. But you will see that money, some of it will be saved, but some of that money is going to go, certainly it's going to go towards expenses, rent, mortgages, et cetera, for those people that are unemployed and out of work. But a lot of people who are getting those checks are also people on Social Security, people who are working. So they put money into everybody's pocket pretty much. So that money is going to get spent, and I think we are going to see some sort of a V recovery. So yes, the first quarter was tough because of March. The second quarter is going to be even tougher. But I think third and fourth quarter are going to be recovery quarters, certainly on a percentage basis coming out of the trough we're in. You're going to see an economy that can snap back maybe even double digits. Now, if you're down, some are talking about GDP being down 30 to 35% in the second quarter. If you bounce back 10 or 15%, that's a big bounce back in historical terms, but it's coming out of such a trough that it doesn't mean we're off to the races and the economy's fine, but it does mean we've found the bottom and we're coming off it pretty sharply. And I think third and fourth quarter we'll see those kind of numbers. So that's why, I think yes, the Fed is the primary driver of this market, but it's because of what that money will translate into economically down the road. And so, you do get a very big rally as a result.
So as you're calling for the melt up to happen, you've been forecasting a second shoe to drop. What do you think is going to precipitate that to happen? Sure.
Yeah, that's a hard one for people because they go, well, if the Fed can engineer this, why are we going to have that second shoe dropping? And I describe that second shoe dropping as, I think we are in a bust for sure, and I use the term bust to describe something that I view as bigger than a recession, maybe of the magnitude of a depression in terms of damage, but happening in a very compressed period of time. A depression gets drawn out like the Great Depression was a decade long. This will be, most of it will be encapsulated within a year or certainly no more than 18 months. So that's why I call it a bust, because it's definitely not it's not a normal recession. It's something much more dramatic than that, but it's also not a drawn-out decade-long depression. So I do think we've already started that bust. The damage that was done by the virus in March, April, and going forward here, there's no doubt we're in very deep negative territory on GDP, there's no doubt that the damage has been done in many ways to this economy in ways we've never seen before. So what I call the front edge of the bust will get this rebound and actually higher highs in the market. And then the second shoe dropping will be the deeper part of the bust. You can engineer a recovery, you can engineer, or at least a semblance of a recovery, and provide liquidity and keep things going for a while. But there's been a lot of what I would call more permanent damage done because of the unprecedented way this virus has taken us down. So, there'll be lots of restaurants that won't make it back on their feet, will have to close. There will be lots of businesses that will be declaring bankruptcy. We'll see, there just isn't the staying power. So if this thing, some businesses can snap right back because they have, they're taking the PPP loans and they're able to use that to get back in business and get over the trough. But a lot of other businesses, there just isn't the sustainability of business. It's going to take a while for consumers to get back, for business to return in many industries. And so there's in the second shoe dropping, in the second stage of the bust, it's when we'll see the true financial carnage come, where I think we'll see a lot of involuntary debt liquidation. We'll see a free-falling financial system because banks will be failing around the world. And again, we very focused on the U.S., but this is really a global story. So what's happening here is going to be happening all around the globe. So that's why I do think the second shoe drops.
That's part of the term that you've coined, the global deflationary bust, correct?
I use the term. I started using the term global deflationary bust back as early as I think 2013 to describe what I thought would come at the end of the economic cycle we were in, the one that we had gone in from the 2008-9 crisis. I didn't expect the recovery to last this long by any means, but I wasn't saying in 2013 or 14 the bust was there. I was just saying when the cycle ends, we will see a global deflationary bust. And again, we haven't had deflation globally since the Great Depression in the 1930s, and we haven't had a true bust since the 30s. And so, this was, I have said many times in many of my investment letters over the course of the last many years, that we were going to see something that was the biggest downturn and the first deflationary downturn in the post-World War II era. So, those are big statements, and I've pretty much throughout my letters since 2013 talked about the coming global deflationary bust. Those are all common terms. Global, deflationary, and bust are terms that get used, but nobody at that point in time or for many years after that was ever putting those three terms together. And the reason I was so early in seeing what I think we're seeing now, I certainly didn't anticipate a virus, but it was the leverage in the system, $250 trillion in global debt and quadrillions in notional value of derivatives are both forms of leverage, and they are to a degree we have never come close to before. So this cycle we had leverage just through the roof, and I knew that when we had the next downturn, that leverage was going to turn into something that would make 2008-9 look not mild, but certainly much less. So that's kind of where that all came from, and I think that's what the bulk of what we'll see. I mean, we've taken a big hit here, and I think that second stage of the bust is going to be even bigger. And in that second stage, I expect the stock market to roll over and head into a bear market that will be the biggest bear market since the 1929 crash. So I'm calling for an 80% peak to trough decline. So if the peak is, let's say 4,100, the trough 41, 4,200. The trough's going to be down probably just under 1,000 on the S&P. So that's a huge drop, and you can see what a drop from 3,400 to 2,200, 1,200 point drop did to the psyche of investors. Imagine what a drop from 4,000 to under 1,000 does. So I think we're going to have kind of the tale of two cities this year. This run up to actually a tale of three cities. First the virus and the very fast, unprecedented decline that happened in March, and then a run up into a steep parabolic top, and then a very big bear market. And so I think nobody's going to forget the year 2020 anytime soon. After that, I don't know if you want to go much further than that, but after the bear market, what separates me from other bears, I guess, or other people that are talking about, carnage, is that I am not talking about the end of the world type carnage here. I am not saying that, and there are people out there talking about a depression lasting for the rest of this decade, et cetera. I do believe there's a big recovery cycle that will follow this. I don't think we'll, in the stock market, get back to this summer's highs again for decades. So not only 2020s, but probably 2030s as well will be well below the highs that we see this summer. But I do think we'll have a strong recovery following this bust but I think it's going to be driven not by the consumer. I think consumers, this shop till you drop consumer that we've had for several decades, I think this is the end of that. Consumer will bounce back. You'll have consumer spending in the next cycle, but it won't be the consumer that drives our economy or our markets anymore. It will be an industrially driven recovery. We haven't had an industrially driven recovery since the 1970s. It will also be an inflation-driven recovery. Because of all this money, we will see inflation down the road. It won't be right away, but we will see it down the road in the next cycle. Again, we've been in disinflation for 40 years. We're going to start an inflation cycle following the bust, and we're going to see an awful lot of industrial rebuilding in this country. We've given away our capacity, particularly to China, but to places in the world. And I think this virus has kind of awakened people to the fact that there's more than just cost that has to be looked at when you have capacity, or when you have manufacturing. You need to look at supply lines. You have to understand the reliability. I think you're going to see an awful lot of onshoring of capacity coming back from China in particular. So I think that's going to drive the next economy. There will be other aspects of it, but that will be the driving element. And that will mean a very different group of stocks will dominate the stock market. So we're I think in the very last stages of a secular bull market that has been going on for 38 years, and I think what comes after this will be something quite different.
So once we see that second crash, David, what does that mean for the dollar? Are we going to see possibly the end of the U.S. dollar as a global reserve currency?
Well, down the road, that's possible. That's one of the things that separates me from that gloom and doom crowd, too, is those that are talking about the end of the U.S. as we know it, the end of the dollar as we know it, et cetera. I'm not in that camp. I am short-term bearish on the dollar. I'm calling for a decline. Dollar got up to 104 here recently and is now down, I think, down around 98. I'm calling for it to fall to about 85 here in the next several months, probably coinciding with the melt-up. And then I think we get a big run in the dollar during that second stage of the bust, because as hard as we're being hit, I think you're still going to see the investors around the globe run to the U.S. as the safest place on the planet, for safe in terms of, our systems being more consistently, we don't we don't break contracts. We don't do all those things that are happening in China and other places around the world. So you'll see, money gravitate to the U.S. dollar and to the U.S. Treasuries because we're still looked upon as kind of the safest place in crisis. So even though we'll be hit hard, the dollar will be going up, and money's going to be pouring out of the Fed once this second shoe drops. So we'll be creating a lot of dollars, but we'll be creating a lot of, the ECB will be creating a lot of euros. Bank of Japan will be creating a lot of yen. People's Bank of China will be creating a lot of yuan. So you're not. We're not going to be in isolation in terms of all that money that's being created. So the dollar can go up as the currency that's safest during crisis, and will. So I think you can go from 85 that I think we get to this summer and rally up to as high as maybe 140 or higher during the bust. And then from there, I think in the next cycle, as inflation gains traction, and I think inflation doesn't really become an issue until out beyond 2022, might see it come out of deflation. Deflation is negative inflation, so you could be down at negative 4 or 5% inflation at the bottom of this bust. So it's going to take a while to get back up just to inflation in, say, 2022. So you might have some minor inflation in 2022, and then start ramping up from there to 3, 4, 5% inflation in 23 and 4, and by mid-decade, you could be in the high single digits, moving towards double digits in inflation. So that will have an impact on interest rates in a big way, but it'll also have an impact, I think, on our ability to service our debt. Because keep in mind, our debt's going to be so far beyond what it is even today, and it's way high now. So it's easy to service debt when you have 0% interest rates. It's a lot harder to service that massive debt when you have double-digit interest rates, and that's what I think we'll be heading for. So I think late this decade, I can certainly, buy the argument that we could see the U.S. dollar lose a lot of its status as a reserve currency. Certainly, a lot depends on what happens with China. We're not in a vacuum with this disaster. So, China's going to have their problems, particularly if not only the U.S. but other places like Japan and Europe pull capacity out of China. They're going to have a problem as I think they may have created a real problem for themselves in terms of their credibility, and that's going to hurt them going forward.
So in that deflationary environment, we're going to see the U.S. print beyond anything we've ever seen, which will lead to the inflationary environment when all those dollars come back, right?
Yes, we keep in mind I think probably by this summer you'll have seen the Fed balance sheet grow from where it was under $4 trillion beginning of this year to up towards $10 trillion, and then I'm guessing if we get the kind of if you get the market moving into new highs and ultimately above 4,000. I'm guessing you're going to have the Fed saying, we got to pull back some of this liquidity. Things are, the economy is starting to recover. We don't want to pull the rug out from under it, but we need to, pause at least. So I think you're going to see a pause in that expansion, balance sheet expansion and expansion of money, late this summer and into the fall. And I think this economy is still not going to be on its feet, and any pause, I think, contributes to that rollover. And I think we're going to find that second shoe dropping can be just as fast as the first one, as we saw in March, how fast things can go from seemingly okay to disaster. I think that's going to be the story of this whole bust, is how fast the unwind can happen. So even a pause of a few months in money could lead to, what I'm describing as the second stage of the bust. So, and, that's the monetary side of it. And as I said before, the other part of it is just the companies don't have the staying power, and you see involuntary debt liquidation. So yes, one once that happens, once you get into that second shoe dropping or second stage of the bust, the Fed's going to have to come in with both feet. So we grew the balance sheet from $800 billion back in 2008 to $4.5 trillion in 2014, and then they started taking the money back. They leveled off and then started taking the money back. We got down to about $3.8 trillion in at the beginning of this year, and then they've grown it back up now towards $7 trillion, on our way to, I think, $10 trillion this summer. And then I think once that second stage bust hits, you'll see the balance sheet grow to at least $20 trillion, and I wouldn't be shocked to see it up at $30 trillion. Those are numbers that are just mind-boggling. But when you have a free-falling global financial system, and I mean free-falling, meaning some of the largest banks around the world going bankrupt, going bust, when you see that in the second stage, every central bank in the world is going to be throwing money in there because they have no other answer. There's nothing else. You'll see fiscal response as well, but there's nothing that moves as fast as pouring money into the system, and that's what it's going to take, because this is going to be happening in a domino effect, one after another. We kind of got a taste of it in the fall of 2008 when the commercial paper market was about to shut down and GE was about to go under, et cetera. And we did TARP at that time, and it took a couple weeks to get TARP in place, and that was rapid for the Congress to do something that quickly. But we're seeing this time around things are happening even faster, and we're seeing Congress coming together with packages of things that we've never done before in a hurry. I mean, that's not the typical style of Congress. They like to deliberate, and certainly have a big divide between the two parties on solutions, and yet you're seeing the parties come together and say, we don't have a choice, we got to do this. And so you'll see more of that, and in much bigger fashion in the second stage of this. And of course, the Fed, when you're in deflation, and this is something I've argued for several years, because rates were so low, you've heard for the last 2 or 3 years, the Fed's almost out of bullets. There's only, so many more rate declines that can happen. So if we get a recession, they're not going to have much ammunition. And I pushed back against that. I was probably the loudest voice out there, maybe lone voice out there pushing back and saying it's actually quite the opposite. In deflation, which is where we're headed, the Fed has almost unlimited ability to ease, because easing is not just rate declines. That's the way of the market, and the street likes to focus is on rate declines. But really, money is a big component of easing. And in deflation, because there's lags to when that money turns into inflation, the Fed has almost limitless ability to print. So that's why you can go from $4 trillion to $10 trillion in a matter of months. That's why, and not blink an eye, because where are rates? They've just increased the balance sheet by $2.5 trillion. What has the 10-year Treasury done? It's gone down. So it's a real problem down the road. Don't get me wrong. I'm not advocating for this. I'm telling you this is inevitable. They don't have a choice. They will deal with the things that are hitting them in the face right now and worry about the inflation that comes later. They'll worry about that later. So there is an ability, almost unlimited ability to print money. And if you've got the biggest banks in the world going belly up, they're not going to sit back and say, hey, we can't do this because it will be inflationary somewhere down the road. They're staring at deflation and big deflation if they don't do it.
So now that we've painted that very gloomy macro picture, are there going to be any safe havens? What do you see coming down the road for gold and silver? Are we going to be able to preserve some of our wealth in those markets and those physical, let's say physical or minor stocks?
Yeah, I'm a big bull on both gold and silver and the mining stocks, but I will preface that with saying that it'll come in in stages, as all markets do. It's not going to be a straight line. So right now, I'm a bull. I mean, I think gold can certainly get up above 2,000, and kind of like my call on the S&P where I say 4,000 plus. It's the same thing with gold, 2,000 plus. So I don't know whether that means it'll go to 2,100, 2,200, 2,300, but I think it's certainly at a minimum 2,000, and I think likely above that between now and Labor Day. So you've got that, and silver, I think, between now and Labor Day can get up to 26. So, currently down at 15, that's a big run. So I'm very bullish short term or in the next several months. When the second stage of the bust hits, I think it's going to hit almost all assets. The exceptions will be the dollar and U.S. Treasuries. But beyond that, I think almost all assets are going to get hit and hit hard. So, wherever gold gets up to, let's say it gets to 2,200, it certainly could be cut in half in the bust.
Is that simply because people are just going to be trying to liquidate and get any cash out of the system that they can?
Yeah, that's certainly part of it. I think, you sell your winners. When you need liquidity, you sell what you can, not what you want to sell. And so it'll certainly be part of that. But as we just saw in March, there's also, you've got, ETFs come into play. You've got, what you end up with is in so many assets, partly for what you just described, what you just asked about, but also other reasons. Everybody's on one side of the trade, and you have a very illiquid trade, so you get a lot of sellers, not many buyers. And of course, keep in mind, I've argued against a lot of people on this for years. There are people that look back to the 1930s and say gold went up in the Depression and in deflation, and I go, that's not the normal situation. You had other reasons for gold going up then, but I think basically gold does not do well in deflation, and it's not a place where you can hide when you're going through what I'm saying we're going to go through. So I do think gold will have a big step back after this big run into the summer, and I don't know whether that step back takes you back in half or 60% or 40%. It's a little hard to figure that one out at this point. I know there are, particularly the Elliott Wave folks out there talking about 800 on gold, and I think that's not beyond the realm of possibility, but I wouldn't also say that that's etched in stone. I think it might fall back to 1,000, it might fall back to 1,400. I have no idea, but I think it will definitely correct. And then once you come out of that bottom in the bust, I think you'll see gold from wherever it starts, whether it's 800 or 1,400 or 1,000. I am forecasting with a lot of conviction that you'll see gold over 10,000 before the end of the decade. So in that inflationary cycle that recovery cycle that I'm describing coming after the bust, gold will be one of the lead groups, and the miners certainly will be big beneficiaries as well. Silver, just to kind of fill out the two, silver in as I said, can get to 26 this summer. I think it can fall down maybe as low as single digits in the bust, but certainly down towards that. And then I think in the recovery cycle could get up as high as 300 or higher. And so both gold and silver miners should be big beneficiaries in that. As I like to say, the gold and silver miners may, in the next cycle, be what the dot-com stocks were in the 90s cycle. You're going to see a lot of new mining efforts, new companies formed. They'll be out exploring in places that are not viable when gold's at, 1,500, but are very viable when gold's at 5,000. So I think you'll see a lot of investment banking surrounding that group. You're certainly going to see a chance for them to finally really make some money.
And what's your kind of timeline for that?
Well, again, the decline happens in the second stage of the bust. And then I think from, say, second half of 2021 through, late 2020s, you can run from the lows to the highs. So I'd expect the peak in gold and silver to occur somewhere between 2027 or 8 and 2030.
So as we know that oil is one of the biggest costs for gold and silver miners, David, are we going to see these crazy low prices and volatility in oil at those times as well?
Yes, absolutely. Obviously, the drop in oil prices here is a beneficiary to, or benefits the mining companies at this point. It's not the only part of their story, but it is certainly reduced their costs as it does for airline companies, et cetera. By the way, I had a $10 estimate for oil or forecast for oil going back, a few years, and I got beat up pretty badly even early this year on that forecast. When oil rose from 26 to 75, when it was up around 75 a couple of years ago, I reiterated that I thought we'd see $10 in the next, that I thought 75 was the end of the bear market rally in oil, and that it would roll over and head for $10 in the coming bust. And again, I wasn't saying it was imminent. I was just saying we're going to, stair-step our way down towards 10. And I got a lot of pushback even as recently as early this year, saying you're nuts, it'll never go to 10. The oil companies can't withstand $10. I said it's not up to the oil companies. It's what supply and demand does, And I said it won't stay there very long. So, some will fail, but most will survive it. And I think you're seeing now that they are going to, the government will step in and figure out ways to get a lot of these companies through this. And so I do think oil can rally here back towards 40, maybe even as high as 45 before Labor Day. I think we have seen the bottom, and I think we're in the process of bottoming in oil here. And I think you could see as Russia and Saudis pull production down, and the U.S. Companies shut in production. I think you will see. I know the story right now is all focused on the lack of storage, but I think you will see that we've pretty much put in the bottom, and that we'll see oil rally here for the next several months. But from there, let's say it gets back up over 40. From there, I think in that second stage of the bust, it'll come right back down here and retest. I don't, given what happened this time, I'm not sure you'll see negative oil. I think that was more of a financial future story than anything else. So I'm not going to try to forecast the exact bottom in oil, but I think it will come back and retest the $10 area or thereabouts. And then oil, I think, in that inflationary recovery cycle, and that's going to be industrially driven. And again, this is a U.S. story, but I think it's basically the story globally is going to be industrial resurgence. Every economy is going to be doing infrastructure or stimulus, et cetera. So I think you're going to see commodities, oil, copper, even agricultural commodities, I think will all be big beneficiaries of all this money that's getting poured into the worldwide system. And so I would not be surprised to see oil up over $300 a barrel, later this decade, whether that's 26, 27, 28, somewhere out there. I think you'll see oil, at somewhere above $300 a barrel.
Well, you're painting a very complete picture there for us, David. Do you have any concluding thoughts as we wrap up here?
Sure. We haven't talked about bonds, so I'll just talk about that briefly. I was one of probably three guys out there that remained bullish on bonds through this whole cycle, as because I was calling for disinflation to ultimately move to deflation. I have steadfastly stayed with a view that the 10-year could drop to, going back several years, I used the number 0.5% on the 10-year, 1% on the 30-year. Late last year, early this year, I changed my numbers to 0.25% on the 10-year and 0.5% on the 30-year. And again, this was before I saw what the virus was going to do. And obviously, we got to 0.31 intraday on 10-year in March. I think my 0.25 point and 0.5 point numbers for 10 and 30-year respectively are going to prove to be conservative or too high. I would not be surprised to see the 10-year down at 0 and the 30-year down at 0.25 or whatever. Only in the second stage of the bust. But I think in the short run, rates probably can go a little lower here, but we've had most of the move for this stage of the bust, and then I think they will rise in the melt up. You could see the 10-year get back as high as 1.25, 1.5 by Labor Day, because everybody's getting bullish on the stock market and the economy starting to recover, et cetera. And then when the second shoe drops, when the second stage of the bus hits, I wouldn't be surprised to see the move back down from 1.5, let's say, to 0 on the 10-year, 0.25 on the 30-year. And then that will mark, just like the stock market's going to make a top of a 38-year secular bull this summer. I think the bond market, which started at 15% on the long bond and 20% on T-bills, 21% on T-bills back in 1981, it's been a 39-year bull market in the Treasury market, Treasury bonds, and all bonds, frankly. And I think the Treasury market carries forward to those low rates I mentioned late this year, first quarter of next year. And then I think we'll have topped out the bond market from its run from 1981. So a 39-year, almost 40-year secular bull market in bonds will also put in a top. And in the next cycle, when we begin this inflationary recovery, it'll start slow, but then it'll build from there. I think we could retrace the entire move that we saw in the last almost 40 years, so that you can get back to 20% plus T-bill rates and 15% plus T-bond rates by the end of the decade. So, I mean, I'm talking about something that just is mind-boggling in terms of the kind of moves that we're going to have. And the reason, by the way, this all sounds pretty crazy, and, certainly people have a reason to look skeptically on this kind of wild call. But the reason I think we're going to see these kind of big moves is because I think we're at the end of a super cycle. I define a super cycle as that huge cycle between two depressions. So I think obviously the last depression was ended in the late 1930s or 1940, and the next depression begins. Like I said, this is a bust, not a depression. But I do believe when we get to the end of this decade, we probably are at the end of the super cycle, and you will begin what could be multi-decade long depression because of the imbalances that will be massive. I mean, truly massive at that time. So if you have hyperinflation combined, and this is the end of this decade, hyperinflation combined with the kind of debt that's going to be throughout the world, and you have, with hyperinflation, you have the opposite of what I'm describing now, where the Fed has limitless ability to print. When you have inflation roaring ahead, in double digits, high double digits, the Fed's out of the game, as are all central banks, because you can't pour more fuel on an already overheated fire. We learned that back in the early, late 70s, early 80s. Part of the reason we got the hyperinflation we got was because G. William Miller, the Fed chairman at the time in the late 70s, was pouring money into an already overheating situation, and it just took off. So the Fed won't be able to help anybody, nor will the ECB or the Bank of Japan or anybody, any central bank, and you're at that point, it's just basically, we will see the collapse of the system. So the difference between me and the gloom and doomers out there that want to say that we're at the end game now is I think we have one more cycle before we get there. And the reason we have one more cycle is because the central banks have a limitless ability to keep this thing afloat for one more cycle. So that's a good way to end it, I think.
Absolutely. There's a lot there to chew on. I want to thank you very much for your time today, David. I want to remind everybody to sign up for our mailing list at palisaderadio.com. David, thanks so much for your time today.
Okay, thanks, Tom, for having me. Take care.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?